Tuesday, there was the 206th Monetary Policy Committee meeting. It was concluded on that day with 11 members unanimously agreeing to hike rates. 6 of them proposed an increase by 100 basis points, and this was adopted. Well, this is the second consecutive hike in rate, moving the monetary policy rate from 13% to 14%. Needless to say, it's going to have a widespread effects on everyone, including yourself and myself. Let's discuss the possible impact on investment and relative issues with Dr. Omobola Adu, investment research analyst with Afrinvest. Good morning, Dr. Omobola. Thank you so much for joining us.
Good morning. Glad to be here.
All right. So I think one of the major questions that's coming out of this hike in the rate is, do you see the hike in this MPR taming inflation?
Yeah, so thank you for that question. I think to start with, right, we have to realize that inflation is not just a monetary factor. It's also driven by cost-related pressures. And by the time you consider what has been happening globally and also in the Nigerian economy over the last couple of months, would see those pressures in terms of cost-driven inflation. And so by the reason of those factors, you don't expect to see a significant impact of the interest rate hike on inflation. I mean, in Europe, we've seen the global energy crisis that have caused oil prices and energy prices to skyrocket. Over the last couple of days, we heard potential news that PMS prices could be adjusted upwards. And by the time you look at all these things together, these things are basically outside the control of the CBN, right? The monetary policy to really has no impact in driving down cost-related pressures. And by that extension, you would expect that prices might not adjust downwards in the near term. Also, if you factor into food inflation is currently around 20%. Most of the staples that we have out there that consumers usually purchase over the last couple of months, most of them have increased over 20%, well above the headline inflation rate. And these are the factors that the monetary policy is relatively ineffective in trying to adjust or to influence the direction of prices of those energy commodities and food prices. Also, if you look at it from a historical angle in terms of the last MPC hike, which was in around May when they did about 50 basis points, we still saw that inflation remained resilient. Just highlighting the fact that Nigeria's inflation is more or less structurally driven. Over the last 3 months, total money supply in the economy has increased by a cumulative growth rate of around 3%. System liquidity has remained tight. Just to bring to the focus that in the economy, the monetary pressures are not so much prevailing compared to the cost factors. And so that tells us that in terms of impact on bringing down inflation, we might not see a significant impact by the decision of the Central Bank and the Monetary Policy Committee.
Yet the central bank governor was he was very direct when he said that as long as inflation keeps surging, the MPC will most likely keep increasing the rate. And so there's this fear of stagflation if rates keeps going up and then it keeps dwindling manufacture and outputs on the other hand. So how real is the fear of stagflation if, as the central bank governor says, rates just keep going up because inflation would not come down?
Yeah. So if you just go back to 2016 and the more recent economic challenges we've basically had a situation where unemployment is going up, inflation is high, and output growth remains weak. And so this situation is not something that is new. It's something that is common with the Nigerian economy, especially once we are faced with external pressures like we are right now. Unemployment rate by available data shows that it's around 33%. Inflation, as we know, is around 18%, and we expect it to move up to around 19% for this current month. And so fears of stagflation, we're already experiencing that already. I mean, in terms of output growth has remained weak. And by the time we look at this impact on a broad basis in terms of what it means for the economy, it shouldn't be surprising if we see slower growth rates in real terms. So basically, when we are looking at GDP or output growth for the economy, right, the higher the cost pressures or the higher price levels are in the economy, you expect that by the time you deflate the GDP in real terms, you should expect weaker or slower growth, and that just confirms the stagflation episode that we believe we are likely to continue to see in the short to medium term. So this, in terms of implications on the economy, when you look at the interest rate hike and likely implications on businesses, the first angle you can look at it in terms of cost of borrowing. So because of the adjustments in the benchmark interest rates, we expect interest rates on other financial assets, including loans and borrowings, should also move in similar direction. And for businesses, in terms of expansion plans, higher borrowing costs means higher interest expenses that we have to pay, which could then lead to a situation where companies might need to cut down on expansion plans or project expansion plans. And in a way, that also affects the real economy because the economy won't be expanding as it should be. And when you look at that and bring all of that into context, we're already having a situation of stagflation there.
Wow. So, I think you've already talked about it, the issue of investment. But let's look at the foreign direct investment. Does this help in any way?
Yeah, so speaking of foreign direct investment, I'd like to speak to it in terms of two perspectives, looking at it from foreign portfolio and foreign direct investment, right? Just to give a bit of context, as at Q1, total capital inflows was around 1.6 billion, the lowest over the last 3 years. Foreign direct investment printed around 115 million thereabouts. And in terms of looking at how it would attract foreign investors, while interest rates are a good thing in terms of, you get your interest income on that. But for foreign investors, it goes beyond interest rates. So you have to look at FX policies. You put your money in today, how likely are you going to be able to get it out as when you need it and at the current or fair market price. And in terms of the interest rates movement, this is more of a concern for the foreign portfolio investors rather than even the FDIs. The FDIs would be more interested about the state of the economy. They'll be interested about the risks of the economy and these foreign policies. Because when you're making an investment, if you're having a horizon that, you want to come into this country and live probably within the next 5-10 years, you want to have an idea of what the exchange rates would be after that period. But looking at our current FX policies, it's a bit difficult for the FDIs to be able to guarantee themselves that by the time we decide to exit this country, this would be the likely exchange rate. And so because of all these issues, and looking at we're also in a pre-election period, some of these risk factors will be at the top of the minds of the foreign direct investors. And if we even want to look at it from the portfolio angle, just like I mentioned earlier, in terms of the FX policy restrictions, we know that there have been issues with dollar shortages over the last couple of months. And so you are more or less concerned that if you convert your dollars today to Naira, how likely are you going to get it out at the fair market price? And so these are some of the issues that foreign investors will be pondering. And by that extension, in terms of foreign direct investment, even though we notice a marginal improvement in Q1, we don't expect it to return back to pre-pandemic or to levels that we've seen before when foreign direct investment used to do roughly around 200 to 500 million on the average, while presently the best we're getting is around $100 million.
Yeah, well, it doesn't look like we can run away from that FX issue anytime soon. But let's look at the possible impact on the financial assets, at this time with this hike in the MPR. How do you see it playing out?
Yeah, so good question. In terms of this, first of all, we know that the monetary policy rate serves as a benchmark for other interest rates in the economy, and they have an impact on influencing short-term rates. So if past event has anything to tell us, the last MPC hike, that was the 50 basis points increase in May. We saw that translate to short-term lending, interbank lending rates adjusting, moving upwards, and by extension, interest rates in financial markets in terms of securities also adjusted, especially for T-bills. So before the 50 basis point hike, interest rates on 91-day Treasury bill were around 1%, 364 around an average of 4%, and after the hike, it initially moved up to around 2% and 6% respectively. But what we noticed was that after a point, it started to wane, or it became, it remained around those same levels, and there was no longer movements. Whereas on longer term instruments like bonds, the 10-year bonds, we noticed that they were less sensitive to the interest rates movement. And so we should expect to see that play out. We expect to see more interest rate movement on the shorter tenured instruments in the market. You also consider the fact that if you want to invest in the longer term bonds, you are basically taking more of a duration risk, and in terms of what you can do in terms of reinvestment. So by the time you look at all these factors together, you expect to say that for the shorter term instruments, you might expect to see interest rates movements more on those bonds. So that is the treasury bills and shorter term bonds. Whereas for the long tenured ones, we should expect to see them remain around the same levels. And even the short tenured ones, even though we expect to see upward adjustment, we don't see it playing out continuously. At some point, we expect it to also moderate and remain around a significant level. This is also when you consider cost of governance, right? Earlier, we noted that as at last year, the debt service revenue ratio is roughly around 87-90%. So this would also be at the mind of the DMO and CBN when they decide to issue these instruments also.
All right, just before we let you go, some people have said that perhaps the MPC is doing this because that seems to be the trend. I mean, we do know the Bank of England, the ECB, the US Federal Reserve, everybody's hiking interest rate now as long as inflation keeps going up. And the result of not hiking it is what we saw. I think that was last week when the euro and the dollar were at par, which has not happened in 20 years. But do you think that there are some homegrown solutions? Because, of course, when we look at Nigeria, the Nigerian situation, we do know that supply costs, supply disruption is a major contributor to, the inflation that we see. Do you think there are some homegrown solutions, that we could use to tame inflation in Nigeria?
Yeah. So just like what I said earlier, in terms of looking at it from what the CBN can do, the CBN is in a way limited. That's because the inflation is largely driven by cost-related pressures. When we look at, like I said earlier, that money supply has remained muted, going roughly around 2%. If you want to now look at it in terms of policies, first of all, the CBN has largely not, focused more on inflation, first of all. So in terms of bringing down inflation through adjusting the interest rates, we might say that there's a little bit of market skepticism concerning that. the CBN stance has mostly largely driven towards accommodating growth and other FX-related issues. So moving the stance now to focus on inflation will mean that they need to, first of all, build a little bit of credibility to say that, we want to manage inflationary expectations. And they hinted that in, like you rightly mentioned, that saying that they want to, that they'll be committed to increasing interest rates in order to bring down inflation. But in terms of looking at it for domestic policies, first of all, it has to do with more or less the coordination in terms of monetary and fiscal policies. And secondly, we also have to look at it in terms of making the Naira more attractive. And that has to, that then goes down to our revenue diversification in terms of exports. We know that in terms of all revenue account for over 90% of our export earnings. So by that extension, we leave ourselves vulnerable to external shocks like we have seen. So in terms of looking at domestic policies, first of all, we need to get things right in terms of FX management. We also need to look at how we can boost the non-oil segment of our export earnings, which would then make the Naira more competitive and by extension help to reduce inflationary expectations.
All right. Thank you so much, Dr. Mobola Adu, investment research analyst with AfroInvest. Thank you for sharing your thoughts with us. Enjoy the rest of your day.
Yes, sir.